All right, everyone, very warm welcome. So this is Accounting 315, and today is our first class. So are you guys excited?
Yes.
Yes.
Oh, that's nice. Thank you. That's always nice. All right, so what we are going to talk about today is, let's start with our course schedule. Now, did you guys notice that I have posted a bunch of recordings on D2L?
Yeah.
Yes.
Yeah, I did.
All right.
Yeah.
Okay. That is awesome. All right. Now, for the recording purposes, could I kindly request you guys to mute yourself? During the course of recording, it just creates, bit of a distortion if it's not muted. But as and when we're discussing the concepts, feel free to unmute yourself, and then we can talk and take it up from there. Okay. So thank you so much for doing that. Okay, so the first thing that we are going to talk about is the schedule. I'm sure all of you guys have already looked at this. This was posted on D2L. Okay, so this is what we are going to follow. Now, we are going to follow this as closely as we can, but that does not mean, there would be no variations. All right. And while I started saying that, I just realized that I started rambling on the thing without introducing myself. So sorry about that. We'll talk about that in just a minute here. So this is what we are going to follow as closely as we can. Now, your midterm exam days are posted. So this course will have 2 midterm exams. The first one comes up on October the 8th, and these will be all online exams. The second one is on November the 12th. Okay. Your final exam is on December the 17th, which is the last day of classes. The marks allocation for this course, your first and the second midterm each is going to be 20% each. Then we have our Wiley plus assignments, which makes up another 20% of your final grades, and your final exam is 40%. And your final exam is cumulative, meaning anything and everything that we talk about from today up until December the 10th could very well be on the exam. All right. Any questions on that?
No.
Okay.
No? All right. Okay, so if that is good, so the exams, as we said, will be online, and we will talk more about the exams and the structures of those and what to expect as and when we get closer to that. It makes more sense to talk about it there. It'll make more sense there. I don't want to overwhelm you with too much information. Okay, I do want to make sure that you come back for the next class. So we'll just leave it at that. Now, if you look at your D2L, let me pull that up. D2L, okay. So that is your D2L. Now, right on the left-hand side, once you get into your contents, this is where I'm looking. So under the contents link, there is Guru's Corner. So everything that you need for this course has already been posted there. So under the general ones, you can find your course outline, your Wiley Plus flyer, and the welcome PowerPoint that was there. Your Zoom class link that you're using, you can use this for every single class. Okay, your lesson slides that we will be using. So this is what your recordings are based off of. So feel free to refer to these ones. Your lesson notes video is what I will be posting for all of your material in the course. Okay, so for this week, for today, we are covering topic 1 and topic 2 in class, and the video lecture for that is posted. So basically all the conceptual ideas are discussed in these. Okay, so I'm not sure if you guys had the time or did know to refer to that information up front, but I did email you guys earlier today as well. So going forward, please make sure to review those videos before the class. So the structure that we will follow is, in the class, we will talk about as many practice problems as we can. All right. And then finally, we have the in-class problems. So in-class problems is all the problems that we will be working on together. They are already posted on D2L. So feel free to use those resources and practice as much as you can. This course is quite a step up from your prerequisite courses. I assume the last accounting course you guys did was accounting 240 or 2110, I suppose. Okay, so this course is quite a step up from that course. So do make sure to have enough time to practice. In order for you to succeed this course, you have to keep your head above water. There is so much going on here. Yeah, so just make sure to find that time to do justice to this. All right. And somebody was asking about the lessons being recorded. Yes, the actual conceptual lessons that we have on each topic, those will be recorded and posted before your classes. That is expected for you to review those. What we will talk about in the class together, we will record those ones as well, and I'll post those the next morning. Okay, there will be no special emails or anything going out, but I will be posting those links. So do make sure to review that. Okay, now having said that though, as soon as students know that the recordings will be posted, you know, I start seeing drop in attendance. Not a good idea, guys. Okay, it is not a good idea, not for this course. If you want to make it through the course, make sure to listen to those lesson notes ahead of time and attend the live sessions. Live sessions idea is that you can get your questions addressed as we are working through them. Okay, listening to the recording is not the same thing. It's not going to give you the same effect. I've done this rodeo multiple times, and the only students who actually do show up for the class and put in the effort and practice are the ones who are going to get through this. Okay, as hard and harsh that it sounds, that is a fact. All right, so that is that. Now, I want to talk about the assignments before I actually introduce myself. I'll get to that eventually. Okay, so this is your Wiley Plus assignment. So under the General tab, you do have the Wiley Plus folder, the Wiley Plus flyer that's already posted. So do make sure that you do register in my section. Right now, when you're getting your textbooks, you can either get a physical textbook or you can get an e-text. Either way, make sure that it does have Wiley logins available. Okay, especially if you're using a used one, make sure to buy those Wiley logins. You don't want to give up on the 20% that is attached to your assignments. Now, all of your assignments are posted here. So the assignment numbers align with your topic. So from topic 1 to topic 13, all your assignments are already posted and they are available for you to do. Okay, now the assignments are coming due in line with your schedule. Okay, so topic 1, 2, 3, 4, and 5. So those 5 topics, the assignments are due on the night of October the 8th. The second set of assignments, which is your 6, 7, 8, and 9, those topics are due on the night of November the 12th. And finally, the last set, those guys are due before your final exam. So those ones are due on December the 15th. Okay, now when you're doing these assignments, I have given you unlimited attempts, so you can keep trying them as much as you want. That's a good resource for you to practice. Okay, couple of things to keep in mind with regards to your assignments. The due date is there for a reason. Okay, once the assignment closes, it closes. I will not reopen that no matter what the reason is. Okay, they will not be open, so it doesn't matter why you didn't get to them. So don't keep it till the 11th hour. Okay, once they close, and we will take whatever scores you have in the system at the time. Right, the other thing is you do have unlimited attempts, but try to aim for 90% score on individual assignment. Anything that is 90%, I will roll it over to 100. All right, but 90 means 90. It does not mean 89.5. Okay, anything under 90 will be considered what it is. So there will be no adjustments. That is right, Ariana. So you are accessing the assignments through Wiley Plus. Any questions on your assignments? And when you are practicing your assignments, you do have the unlimited attempts, as I said. I'm not sure what you guys would see, but I know from my past experience that sometimes Wiley would give you an average score, especially in your view. As a student view, they tend to give you the average score, but don't worry about it. Once you hit 90, I will take the best score, even if you did that assignment again, right? So we will pick the best as long as whatever is there in that window before the due date. Does that work for everyone?
Yeah.
Yes.
Awesome. Okay, any questions on general stuff so far?
I have a question.
Mhm.
Where do we get these assignments?
The assignments are already there under Wiley Plus. So once you guys purchase the Wiley Plus code, then onto your D2L, there is a Wiley Plus under the Guru's Corner General tab. There is a Wiley Plus flyer here. So then you can access my class link through the flyer, but make sure you do have the access code. Once you get in there, then under the assignment tab, you will see everything. So go to assignments, and that's where everything is listed.
Okay, now to get to this online access, Wiley, how do you call it? Wiley?
Wiley Plus?
Okay, yeah. So do we need a link that we can buy this access code, or how do we get it?
Well, the flyer is there. So refer to the flyer that I was just telling you about. It has everything that you need. So this flyer here.
This is in D12, huh?
Yes. So in D2L, refer to Guru's Corner, and everything is there.
Guru's Corner, then it is in general or in class problems?
In general.
In general.
Mm-hmm.
Okay. So, okay. So the third one, this Willy Plus Flyer,
Yep.
this is the way we can buy the online code?
Yes, it'll give you the link.
Okay, thank you.
Alrighty. All right. Any other questions, guys?
I have a question, please.
Mm-hmm.
So just wondering what's you wrote topic 1, 2, 3, 4. Is this what you mean by chapter 1, chapter 2, and 3, 4?
No, so we have to go by the, okay, hold on. I will try to pull up the course outline here. So SATE expects us to follow a course outline. Okay, so for this particular course, they have divided everything in terms of topics. So I have to follow those topics to make sure that we are achieving all of those. So this is topic 1, topic 2, topic 3. Okay, the easiest way to know which chapter to refer to is if you go to the in-class problems. I'll show you the Excel that is open right now. So this is the Excel that we will be working on today. Okay, so this is on topic 1, if you see here. But if you look at the tabs, these are your question numbers. So E2 comes from chapter number 2. Okay, so that ways you can make that relationship to know what chapters there are and what chapter the topic covers, because there are some topics that covers multiple chapters, and then there are multiple topics that cover the same chapter. So that's why.
Oh, I was confused a little bit because I was trying to read from the textbook, and you said on the first 2 videos that they are just refreshment information, and they might not be in chapter 1 even, right? This is what I understood.
No. The information is there, but
Oh,
it's a refresher. But it's you know, the information is there in your chapters. Yes, and that's where I'm picking up the stuff as well.
okay.
Yeah.
Thank you.
No, so I haven't created anything right from scratch, like, okay, but it's all coming from the textbook that you guys have.
Okay, so usually are the PowerPoints and the lectures, the videos that you're sending us are enough for us to study and do the examples, exercises, or do we need to refer to the textbook all the time?
Well, the textbook is a mandatory resource. My material is meant to supplement your textbook, not to replace it. So I would not take a chance of not getting the textbook. Okay, so make sure to, it is needed, it is required for the course, and there are quite some variances and differences compared to the earlier version.
Okay, thank you.
All right, okay, welcome. Okay, so that is that. Any other quick questions before we get into the stuff?
Yeah, I have a question. I saw on the D2L at the Guru's Corner, there I saw like textbook. It says textbook to the 12th edition on there. So is that the textbook we're supposed to buy?
Yes, it's listed in your course outline, right?
Yeah.
So your 12th edition is what we are buying for this course, yes.
But I saw there was a link, a textbook link that was on the D2L.
Oh, okay, yeah. So the 12th edition is what's in the circulation right now, and that is what we are buying. So the textbook looks like this, the first one.
Okay, yeah. Okay.
Yeah, this is the KISO Volume 1 12th edition textbook.
Mm-hmm. Okay.
All right.
All right.
Okay. Okay, and as again I said, textbook is mandatory. Get the 12th edition. Okay, so that is that. With regards to, let's see, I just had a fleeting thought. I was going to say something and I missed
I have a
it.
question, please, with the textbook.
Okay.
Is there any difference between volume 2 and volume 1, or it's almost the same?
No, it's not almost the same. It's far out. Okay,
Oh,
so
so it
yeah,
should be volume 1?
the volume 1 is 315 course, guys. Okay, volume 2 is the accounting 350, the next course. You're talking about two different courses. So for this course, you need this textbook. So this is volume 1, KISO 12th edition.
12th edition. Okay.
Yeah, okay. So ISBN, if you look at the slides that I have posted, all of the information that you guys need is already posted, guys. So please take the time to review the D2L information. Okay,
Wow.
we want to make sure that, you know, our cumulative time together is best use for everyone. So everything that you need is there on D2L. But if you have any, you know, individual questions, then feel free to email me. I'll be happy to address them there. All right.
So
Okay.
the cover is the same, but they're for different courses. The edition even.
Yes, the volume 1 and volume 2, as I said, is entirely two different courses.
Oh my God.
Yes, so volume 2 is accounting 350, which is intermediate accounting 2, which comes after this course.
Okay.
Yeah. All right.
So can you buy this hard copy, because I prefer to use hard copy than this digital?
Yes, you can. And all of that information is on D2L. You can buy e-copy, hard copy, whatever you want.
Okay. Yeah.
All righty.
Okay.
Okay. So that is that. And I still can't remember what else I was going to say, but I guess that should be good then. Okay, so our time together then. So since we are following the asynchronous, guys, can you please mute yourself? Okay, so since we are following the asynchronous learning where the lesson slides or the lecture notes are available ahead of time, our time together is going to be limited in that aspect. Okay, so our classes will range anywhere between 1.5 hours to 2 hours because you already have access to those learning or the video recordings. All right. Now, that would depend on the concept that we are covering and what all we are talking about and the flow. So it could be anywhere in that. One last thing that I did want to say that all the material that is posted under Guru's Corner, that is, you know, proprietary stuff. So please make sure not to circulate that. Okay, I have put in lots and lots of time in customizing this information. I, you know, believe it or not, I've put close to 100 hours, which I don't get paid for. Okay, so there is a lot of time and effort that goes into these courses. So please make sure not to circulate this and take this lightly. All right, so that's that. But yes, finally, let's just do the introduction. So I am your instructor, Gurpinder Gill, in case you haven't figured that out by yet. So I go by Guru. You can call me Guru, Gurpinderji, I don't care, whatever works for you and whatever is easier to remember. I have been in the teaching business for a really, really long time now. In fact, this is where I started. So it's a full circle. Currently, I'm working with the mining business in downtown Calgary. I work as a controller with them. Yeah, so, you know, when we are talking about the concepts or when we're talking about the material, I might on and off bring in a couple of live examples to explain the concept, to put things in perspective. There is no other intention behind that. Okay, so that just disclosing that. Okay. So are we good? So how many of you guys actually did get the time to review those PowerPoint slides and the videos that was posted on topic 1 and 2?
I did. Kenny did.
Okay.
I did.
Okay, that's good. So
Yeah, same here.
I did too.
awesome. That's amazing, guys. Awesome.
Yep.
That's a great start. So that ways what we can do is, if you guys did have the time to review that, that's wonderful. So just keep up with that. So then what we will do is we will jump right into the examples for the topic 1 and topic 2. Now, just as I was saying in the recordings there as well, sorry, I'm using Zoom for the first time, so I have no idea how half of these things work. Anyways, so, God, I'm getting old. Lost that again. What was I saying? Oh, with the practice problems. So we will jump right into the practice problems. And while we are discussing this, we'll try to explain this as much as we can. If you have any questions, concerns, feel free to either type it in the chat function. And I usually try to keep, I have 2 screens, so I keep the chat on the other screen just to make sure that I'm not missing anything. But if I do accidentally end up missing something, feel free to remind me. Okay, if you're more comfortable just unmuting and talking, then that works too. Whatever works for you, okay? Now, topic 1 and topic 2, the reason why we're trying to cover both of this today is that this is a refresher. It's purely a refresher. There is nothing new that we will be learning today, okay? Not saying that we won't learn anything, but there is nothing new, okay? This is actually coming from your prerequisite courses, so the first class is usually just getting our feet wet and getting, you know, sense of the land. That's pretty much what it is. Okay. Any other questions before we actually jump into E2-3, which is coming from topic 1, and this Excel is posted. So if you guys want to do this while we go, then go back to Guru's Corner under in-class problems. We are referring to these Excels in topic 1 and topic 2. So are you guys set then?
Yes.
Yep.
Yep.
Yes.
Awesome. All right. So let me find, where is my textbook? There it is. And oh, or I did have that. No. Okay, so this is the first example we are looking at, E2-3. So we are looking at a bunch of qualitative characteristics here. So they have given us relevance, verifiability, freedom from error. So there are a whole lot of that, about 12 of those are stated. Now, under the instructions, identify the appropriate qualitative characteristics to be used given the information provided below. So what I've done is, just to make it easy here, I have brought the same information here. I haven't created anything. Is that good enough size, guys?
Yeah, that's good.
Yes,
That's good?
Yeah.
Okay.
Yeah, that's
Without
good.
straining too much, yeah? Okay. All right. So the qualitative characteristics being employed when companies in the same industry are using the same accounting policies. What do you think they're talking about here? Or do you want me to keep the question and the choices up? If that's easier, then that works for me too. I don't mind it either way. Do you want to look at this screen?
Yes, this way is easier, please.
Easier? Okay, sure. Okay, so we are looking at the first one. So the qualitative characteristics being employed when the companies in the same industry are using the same accounting policies. So what really are these guys talking about here? Any guesses?
Consistency.
Consistency?
Comparability.
Comparability? Anyone else?
Comparability.
Comparability? Okay, this is about comparability because any company, okay, you could actually go with the consistency as well, and I can see why you're thinking about that, but in this case, it is comparability. The companies need to apply their accounting practices consistently year after year, okay? What do they mean by accounting practices? Can you give me an example? Like, what are they thinking about here?
Acceptable guidelines.
Acceptable guidelines, okay. But even under the acceptable guidelines, there could be different options, right?
So things like how you account for inventory and things like that?
Ratio analysis kind of formulas, I think.
No, ratios analysis is more of a performance measurement, okay? But, okay, so following GAAP is one thing, guys, but even under GAAP, keep in mind there are alternatives that are provided. So let's say, for example, when we are thinking of how to account for our inventory account, okay, maybe that will make more sense. So under the inventory accounts, if you guys recall from your earlier course, the inventory can be accounted under first in, first out method, or you could use the weighted average, right?
Yes, yeah.
Right? So amongst those methods, once the company picks a method for something, do make sure to apply that same method consistently year after year so that the companies can compare that information to see whether they are doing better or they are doing worse. Okay, now comparability will be compromised in 1 year if the company says, I'm going to use FIFO because this is going to make my numbers look better. And usually, you know, that's the thinking process. And in second year, I'm going to use the specific identification. Okay, so if the company did that, then comparability aspect will be compromised, which is not a good thing. Okay, now having said that, it's not that easy to change your accounting policy. So it's really not a company's choice to say, you know, this year I'm going to do FIFO, but next year I'm going to do specific identification because I feel like. No, there are strict guidelines as to when they can change and what they can change to.
About like depreciation formulas straight or?
No, because that is estimates. That is estimates, and we'll talk more about that when we get to our capital asset chapter, when we discuss the property, plant, equipment, those type of long-term assets. We'll touch base on estimates at the time, because no, that is not part of the conversation here. Okay, so the first one is referring to your comparability. So the second one, quality of information that confirms users' earlier expectation. Now, when the, okay, can you please mute yourselves? Okay, thank you. So when the companies do prepare their financial statements, these financial statements are issued out in the market, okay? Now, why is anyone looking at that financial statement? Primarily for two reasons. One is they want to look at something ahead and say, let's say if I'm trying to decide whether to buy shares of this company, that could be one reason, okay, that I'm trying to look at their past performance and predict their future, okay? So that's predicting the future, okay? I can look at the same information and say, well, last year I got the shares and I want to know if it was a good decision or a bad decision, okay? Then I can look at it from the confirmatory perspective. So one is in the past, the other one is in the future. So what do you think these guys are referring here? They are looking for predictive value. Thank you. Predictive value or so, okay, slight difference. Okay, somebody said predictive value and I just ended up saying the same thing, but it's not the predictive value, it's the feedback value. Okay, predictive value is when you're looking into future. Feedback value is when you're looking in the past. This guy had an earlier expectation. Oh, come on, how do I? Okay, so this guy already had an earlier expectation, so he's looking more for a confirmation. Okay, so that is a feedback value in this case. So if you were to put predictive, then that will be wrong. Next one, necessary for providing comparison of a company from period to period. This is where we talk about our consistency. Okay, and sometimes with these ones, you could argue whether that is consistency or comparability, but in this case, yes, it is consistency. D, ignores the economic consequences of a standard. That one is an interesting one. What do you think?
Neutrality.
Neutrality?
Yeah.
Okay. So why is that? That is right. It is neutrality. But what does that mean?
It looks like being ignoring something or a standard, just being neutral, not going to any side.
Okay. It actually, close enough. Okay. So now think of it this way. I have two beautiful kids. I love them to pieces. So I have to at all times, they keep telling me, oh, you favor him more. No, you love her more. So I always have to maintain a very neutral stand because they're both my kids and I love them equally. That's pretty much what neutrality is. You always have to be neutral. You can't pick favorites. So when the companies are preparing these financial statements, they are ignoring the economic consequences. Okay, so they are not looking at the standard to say, well, if I have a choice, can I do it this way because it will make me look better? That's the wrong way of thinking. That way you're not being neutral. What you're doing is you're actually trying to favor a set of users. Okay, so D is neutrality. You cannot look at the economic effect of a transaction. You have to go with the best representation that it will give the business. All right. E, requires a high degree of consensus among individuals on a given measurement.
Consistency.
Consistency?
Verifiability.
Verifiability, yes. Okay. Now, okay, so what they're saying is, let's say when the company says I've got $50,000 of cash in my bank at the end of the year. That's the number they have reported on their financial statements. Now, when different set of users are looking at that information, they should be able to come to the same conclusion. Okay, so that is your high degree of consensus amongst individual when it comes to measurement. So all of them should be able to come to a same conclusion with regards to that item. So that is verifiability. It has to be verifiable. If it's not verifiable, then different people will come to different consensus or different conclusions. All right. F, predictive value is an ingredient of this fundamental quality of information. That is relevance, and that would come from your notes. So there is some theory aspects that you just got to know. Yes, okay. Next one, 4 qualitative characteristics that are related to both relevance as well as faithful representation. That also comes from your theory in the notes. So that is your comparability. Okay, ability to compare from one year to the other or between one company to the other company. Verifiability, meaning that somebody should be able to verify the information that you are stating. Timeliness, what is timeliness? Any idea?
Timeliness is
They should be available on time to make like a decision.
That's right. So what does it mean? Like, what is the good time? Yes, Anjali, go ahead.
So for like the 8th question, I was like basically testing myself because I like tried talking to you a lot of time, but I couldn't do it.
Oh,
So
okay.
testing it, so I was.
Okay, I think it went muted, but I can hear you, Anjali.
Okay, thank you.
All right. Okay, so timeliness is, as you said correctly, it is providing those financial statements while they add value. If the financial statements are provided too late in the game, then they are really not going to add any value to decision makers' thought or their decisions. Okay, so when we look at timeliness, we usually look at a year. So the companies are expected to make their financial statements at least once every year. Okay. So that was the third one. And the fourth element to that is your understandability. Understandability is a very common thing. So what that means is the financial statements has to be following the guidelines, and it has to be understandable to a user with some level of financial understanding. Okay, I can't expect my 10-year-old to understand the financial statements if he has no idea about anything, right? But with somebody that has reasonable understanding of financial statements, should be able to comprehend them without any challenges. So which means, again, we don't want our financials to be overly complicating. Don't use too fancy jargons, too fancy language, or layouts that are complicated. Give them too much or too little. That is what we are talking about with the understandability. Okay. H, neutrality is an ingredient of this fundamental quality of accounting information. That, guys, is representational faithfulness. So when the accounting information is presented, the users want to be able to trust that information. And that only comes if there is faithfulness aspect built into that. When the information is presented in completeness and it is verifiable and it is complete and verifiable. Okay. Two fundamental qualities that make accounting information useful for decision makers. Sorry, go ahead.
Relevance and representational faithfulness.
Perfect. So the relevance, your information has to be relevant. If there is anything that is not relevant, we are not going to report it, okay? We as an accountant, so the accountants need to make sure that any information that is relevant and has to be included in the financial statement. Okay, for example, let's say you were doing your financial statements for December 2019. The company received, so in March, you're still working on finalizing these financial statements. And in March, you get a legal notice to say one of your customers is going to sue you or is suing you. Okay, then what would you do? Your financial statements are for year of 2019, January to December. The legal notice comes into March 2020. Feel free to unmute yourself. Let me know your thoughts. Do you think that's relevant for your users to know or not?
Yes.
Why?
Because maybe our reports are like, if we are making a report in the end of the year, but the notice is in the middle of the year, maybe it's March, so we have to tell them, even if there is interim report, we should like inform them the status of the company, because
Okay.
But also, I think also that, for example, if we are talking about the stock market, is we know how the company is working, I can take a decision if I sell or not my shares.
And that's absolutely right. I mean, good observation, guys. So what we are agreeing to here then is that the information is relevant. So you are doing the financial statements for 2019, but you're also telling me that even though the notice came in 2020, Your gut is telling you that yes, it is relevant information because my user wants to know if there is something going on with the business. User wants to know if I should hold the shares, should I sell them? Is it a good time to get out before it's too late? Or should I invest more? Right? And that's exactly what happens. The other thing to keep in mind is in this case, when you are talking about your legal notice, okay? Now, legal notice, guys, accounting is very logical. So if you break down your transaction or break down your equation on a very fundamental level and try to understand the logic behind it, most of your questions are going to be answered. Okay? So if we got the legal notice in March 2020, they are not suing us for something that we will do in future, right? They are suing us for something that we have already done in past. Your financial statements that you are reporting on is your past. It makes it very relevant for you to report on it. Okay, so understanding the logic of why you need to do it probably would help you retain that information better. So in that case, yes, that is your relevance and representational faithfulness. Okay, last one, issuance of interim reports is an example of this enhancing quality of relevance. Okay, so there are the basic qualities and then there are the enhancing ones. So that is your timeliness. We want to make sure that our financial statements are represented before, or they go out in the market before they lose their value. Okay, as we said, we are reporting on historical information anyways. So when we are sending out the 2019 information, well, it's already late, right? So you don't want it to be too late. You don't want to be issuing your 2019 financial statements in September of 2020. By that time, they're too stale. Okay, so some level of stale is good, and you need to have that for processing, but not too much. Is everyone good with E2-3?
Yes.
All right, and thank you so much for the participation. Please keep that coming. Okay, it always helps, and it, you know, as an instructor, it helps me to establish a base level and change my strategy about relaying a concept as I go. So please keep talking, give me that feedback, so stay tuned, okay? Okay, so the next one, I had just wiped out the ink. The next one is E2-4. So we will do the same thing, E2-4. Okay, quickly guys, tell me how many statements do we prepare?
4.
Okay, name them please.
Income statement.
Mm-hmm.
Balance sheet.
Mm-hmm.
Cash flow.
Statement of changes in equity.
Okay. And
Statement
somebody's
of cash flow.
awesome. Okay, so those are your 4 financial statements, and they are, and that's a good order to list them in because they are prepared in the same way except for that one minor change. So you will do the income statement first. Whatever your income or loss is will then go to your statement of changes in equity. The final numbers on that financial then goes to your balance sheet, and balance sheet is also called as your statement of financial position. And the based on the cash numbers on your balance sheet, then we prepare our statement of cash flow. So your 4 financials are prepared in the same order. All right. So here we are going to go through these items to say which financial statement they should go to and what category to send them to. So the first one is arising from peripheral or incidental transaction. Peripheral or incidental transaction is something that the company does not do on a day-to-day basis. Okay, let's say if you are thinking of a bakery shop, what they do on a day-to-day basis is sell baked goods. Okay, let's say if the guy bought some shares or sold some shares. Okay, forget even that. Let's say he has an oven, an old oven. He sold that old oven. It is a peripheral transaction. Okay, his job or his business is to use these assets to make baked goods. That's what he does day in, day out. Okay, any peripheral or incidental transactions which are outside of the normal business operating cycle are then going to give a rise to your gains or losses. And these gains and losses, guys, will go onto your income statement. Number 2, obliges a transfer of resources because of a present enforceable obligation. What are they talking about here? Liability. Okay, what's a liability?
Like, uh, it's like a debt. Like, you know, you have to pay somebody. It's like
Something that we owe.
Okay.
It can be two types, current and non-current. So
Perfect. And that's exactly what it is. So this is a liability where we as in business owe something to someone. And whenever that liability is settled, your assets are going to go down. So that will be an asset onto your balance sheet. Sorry, my apologies. That's a liability onto your balance sheet. It could be current, it could be long-term. We just don't know enough information based on this one. Increases in ownership interest through issuance of shares. This is change in equity account. So this will go to equity as an increase. So your changes in equity financial statement will capture number 3, where your ownership interest is changing because of the issuance of shares. Same thing with number 4. They are talking about the cash dividend to the owners, which is declared and paid. Anytime the cash dividend is paid, it reduces your equity. So that change is captured in changes in equity statement, but in this case, your equity will go down. Number 3, your equity goes up. Number 4, your equity comes down. Number 5, an expenditure that has future economic benefit. So you have spent some money, but it does have some future benefit.
Asset.
Balance sheet asset.
Asset, perfect. So that should be a current asset. Okay. In this case, most likely it should be a current asset, but again, we don't have enough information to determine whether it should go as current or long-term, but it's definitely an asset onto your statement of financial position or your balance sheet. Then we have, okay, 6, decrease in assets during the period for payment of income taxes.
Income
your
statement.
asset, sorry?
Income statement.
Okay, what category? So income statement has revenue and expenses. So what are they talking
expense.
about? Perfect.
Income tax expense, yeah.
Income tax expense. Perfect. Awesome, guys. Okay, so when you are paying your expenses, your asset goes down. Think of your journal entry. Okay, debit income tax expense, credit cash. Cash is an asset that's going down. So number 6 is an expense. Number 7 arises from income generating activities that are entities' ongoing major or central operation. Okay, fancy jargon, but what they're saying is this is what the company is doing day in, day out. So think of our bakery store.
Revenue.
This is your revenue. So the money the guy earns from selling those baked goods, that's your revenue. Okay, it's from ongoing activities, and that is your central operation. That's what they do every single day. Number 8 is the residual interest in the enterprise's asset after deducting its liabilities.
Capital.
Capital or equity. Perfect. Okay, capital is also called as equity. So basically that is your asset minus liabilities is what they are talking about here. Number 9, increases assets during the period through the sale of inventory.
Revenue.
Revenue.
Revenue. Okay, so when you sell inventory, you convert that inventory into revenue. Perfect. So that will go on income statement. Asset during, okay, so we did number 9. So number 10 is decreases assets during the period by purchasing the company's own shares.
I have a question. Teacher. Number 9.
Okay.
What is the increase of asset? Increase assets during the period through the sale of inventory. It's not receivables or cash.
Yeah, receivable is an asset. So when you sell your inventory, your journal entry is debit accounts receivable and credit sales account. So accounts receivable is an asset. That's what they're talking about here.
Okay, thank you.
No problem. So number 10, guys, decreases assets during the period by purchasing company's own shares. So when you buy something, again, accounting is so logical, just try to find the logic behind it and your life will be so much easier. So when you're decreasing the asset and they're telling you that we are buying something. So whenever you buy something, okay, most likely 90% of the time it is by cash. So the credit is to cash. That's what the decrease in your asset is. But what are they talking about here? What's the other side?
Shareholder equity.
It's like cash to.
Perfect. Yeah, that is shareholders' equity. So this will be a decrease in the equity. So when the company is buying back their own shares, that is decrease in the equity and the asset account. B, indicate which elements listed above is being illustrated in the examples that follow. First, notes company has a written contract to receive money from the sale of copies of future recordings of music yet to be written.
What's
Where
the
would this?
question, please?
Is unearned revenue.
Okay, so you're talking about number 1 as unearned revenue?
Yeah, it's not in that, but yeah. It's like you're receiving the money for the work not yet done.
No, you're not receiving the money. You are signing a contract to receive the money.
No,
right? It's sorry, hold on one second. So it's two different things. The way you interpret that information, so if you interpret it saying that, yes, you are getting the money, then I would agree with you that, yes, it's unearned revenue or a liability. But in this case, that's not what they're saying. What they're saying is the notes company has a written contract to receive money from the sales of copies of future recordings of music yet to be written. So if it's not written, they're not getting the money today. Whenever they are written and sold, that's when they'll get the money. So it's a contract for future. So this is an asset. Okay.
Receivable?
No, this actually on your financial statements, and this one is a very interesting one, guys. So up until this time, we haven't talked about this with the students. So in accounting 350, we will be, 315, we will be spending some time on revenue recognition. Okay, there is a whole chapter and it's quite intensive when it comes to revenue recognition, and there are so many rules and regulations about that. But in this case, if there is a written contract and that written contract proves to be an asset, okay, depending on the terms of that contract and what it is, it would go to a long-term asset or a current asset. If it's not on the current or long-term asset, then at the least, in line with your relevance and full disclosure principle, this will be disclosed in the notes to your financial statement. So one way or the other, we will make our financial users aware of this information. Okay, because it will generate.
Sorry, what could be the name of the GL?
I am not sure. Frankly speaking, I don't want to missell this. I am not sure because they have given us such limited information. In my experience, if I was dealing with this, I would put this as a note. Because looks like there is nothing that has happened. Nothing has been written, nothing has been sold, and there is no money received. There is a future promise to receive this. So I personally, in my professional opinion, I would put this as a note to the financial statements and let the users know that, hey, the contracts exist, but that is pretty much it. If the things change and the actual piece has been written, or there is something in the contract to outline that, hey, contracts, guys, are a very, very tricky and different business. It depends on how the contract is written. In this case, let's say the company says, okay, we will give you cash today so that you can spend in order to make that music. Right? Can happen. It happens a lot of time. It really depends on how the contract is written. In that case, I will record that money received as a liability. All right? Does that make sense?
Yes.
Okay, sorry. I find it hard to mute myself, so I just keep coughing in your ear. Sorry about that. I think I figured it out now. No, it's not COVID. Oh God, you got to be really careful. I just got tested over the weekend because my kiddo was sick, and you know, we figured that all of us would get tested. So I've never been so excited in life to fail a test. All right, so that is B1. B2, Ready Mart Inc. has inventory out on consignment at a local retailer waiting on sale to the final customer. Any thoughts?
Asset, Ready Mart. It could be asset because it says inventory, which is like not sold. So inventory is a part of asset. Like
Yeah, we still own it.
yeah. So
Still an asset.
so you know, if like inventory, if you it's which is not sold is an asset.
Okay, okay. No, that makes sense. Just a quick thought there, and Anjali, for somehow, you know, when you speak, there is some disturbance. I don't know where it's coming from. So in case there is something that needs to be tweaked or checked or something, okay? Just thought I should let you know. Okay, so yes, you're right. Inventory is an asset, okay? It's a current asset that will go onto your balance sheet. Now, consignment goods, we will talk more about consignment goods when we are talking about our inventory accounts in details in the later half of the course. So we'll look at that in much detail at that point in time. But yes, with the consigner-consignee relationship, consigner is the guy who has ownership of the inventory. So the inventory technically belongs to the consigner. So consigner will always have it on their books, whether or not that inventory is physically on their property. Okay, so in this case, yes, it is an asset. It will be a current asset as your inventory account, and it will go onto your balance sheet. So the last thing here is the Music Corp has written contract to deliver % of future music revenues or royalties from the sales of existing recordings.
Liability.
So this is a liability, okay? What kind of liability? Long-term, short-term?
It seems long-term.
To deliver a % of future music sales royalty from the sales of existing recording. The recording is existing.
So it'd be short term because it's already there.
Exactly. Yes. Okay. Now, again, follow your logic. If somebody was getting a royalty, if you were on the receiving end of this royalty, okay, do you want to wait over a year to get the royalty? I don't think so. Right? Okay, so always, you know, sometimes the information is implied. It's already there. We just need to be able to connect those dots. So yes, this will be a liability. Any questions up until here, guys?
I have question number one. Number one, arise from peripheral or incidental. What are these incidental transactions?
Incidental means that something that is not done on a day-to-day basis. It happens once in a while, or the frequency of those transactions is low. So in accounting term, we call them peripheral. Peripheral meaning that there is a core business, and whatever happens around that core business, it's very rare. That is peripheral or incidental. So in this case, we use the example of the bakery guy has an old oven that he is selling. Now, he doesn't buy ovens every day. He doesn't sell ovens every day. We're talking about those big industrial size ovens, okay? Not the over the top oven, no, okay? The big industrial type ovens. So that bakery guy, his core business is to make the baked goods, sell that, and make money off that. So if he's buying or selling machinery to support that, that's incidental or peripheral. The volume of those transactions is low. Does that work?
Okay.
And then it's going to go to income statement then?
No. Why would it? It's an asset.
Okay, so it's going to go to balance sheet.
Well, I guess I should take that back. There are two elements to that transaction. Okay, whether let's say if that guy is selling the old oven. Okay, because if he's buying an oven, then it's a capital asset. It goes onto your balance sheet. So that's why I said no. Okay, but if you're thinking of it other way, where the guy is selling the oven, then it will have two pieces. One is the asset is going out, and that piece will go to your balance sheet as an asset reduction. The other piece is when you're selling that asset, you could have resulting gain or loss on that. That gain or loss will hit your income statement. So it depends on what side of the transaction you're looking at. Is that good?
But then let's say if there is multiple choice, which one do we need to choose? Or it's not a multiple choice?
It shouldn't be a multiple choice. And, you know, in that case, it has to have more information. It should tell you whether it was purchased or sold. But for the incidental transaction, that one was a gain or loss, which is on your income statement. This one. Okay, either it could be a gain or loss. Okay, but I see why you're confused. It has to be on the sale, not on the purchases. When you purchase something, you can never have, you know, you might get a good deal, right? But you can't call it a gain or loss. So it really, yeah. Okay. The last one we are looking at in topic 1, guys, is E2-6. Okay, so these are the foundational principles and assumptions of accounting. We have a bunch of situations here, and we are going to identify the foundational principles that are listed here. So we are going to match our situation to these principles. So we have 10 of them. So A, allocates expenses to revenues in the proper period.
Matching.
Matching. So the whole idea of matching principle is to match your expenses to your revenues. It's never the other way around. You never get to match your revenues to your expenses. That is criminal. That concept does not exist. Matching is you're matching your expenses to your revenue. So was there an associated revenue generated by these expenses? That is what we are trying to figure here. All right. So the next one is indicates that the market value changes after the purchase are not recorded in accounts unless impairment exists. Do not use the revenue recognition principle.
Historical cost.
It could be
Historical cost?
historical cost, yeah.
Okay. So what really is historical cost?
The value of the asset at the purchase cost.
The value of your asset has to be recorded at the cost that you purchased that. So when you take the asset onto your balance sheet, the number that you record for your asset has to be what you paid for it. It can't be market value. It can't be fair value. It has to be what you paid for that. That's historical cost. Okay, perfect. And B is number 8, historical cost. C, ensures that all relevant information is reported.
Number 10, full disclosure.
Absolutely, that is number 10, full disclosure. So accountants have to make sure that any information that is relevant has to be disclosed. For example, that legal lawsuit that we were talking about, the notice or the letter that you got in March when you're making your 2019 financial statement, that's an example here. So that is full disclosure. D is why plant assets are not reported in their liquidation value. Liquidation value is if I was to sell this asset on today, how much am I going to get that? Okay, keep in mind, guys, when you have your assets sitting on your balance sheet, they are sitting at historical cost, whatever you paid for that minus your accumulated depreciation, right? But liquidation cost is, if I want to sell this asset today, how much money would I get? Okay, considering that the market is so bad, it's COVID, and it likely would be seen as a distress sale, not a very good value, right? So that is liquidation value. So if I want to sell this out today, how much am I getting? So what are we talking about here?
Fair value.
Fair value. Value in use.
No and no.
Not fair value.
Nope.
Okay.
Not
Monetary
fair value.
unit.
Nope.
It can be going concern
Fair
because we don't
disclosure.
know.
Fair disclosure, no. And somebody was saying going concern. Why?
Because it's you just told like you due to this COVID value, like COVID situation, like you know if there is a plant which need to be sell and the depreciation has been reduced, so we don't know about the money. So
Exactly. And that's exactly what it is. By the way, your mic sounds much better, Anjali. Thanks. Okay. So yes, the whole concept of liquidation comes into play only if the company is going through going concerns. Going concern is when the company, okay, I'm going to take a step back here. So when the auditors are looking at the financial statement for the business, they look at the company 12 months from that day and say, does the company have enough money and enough resources to pay their maturing obligation? Is there any indication that this company will not survive another year of operations given their current situation? That is a going concern test that the auditors do at the end of the year. Okay, before they do the audit report. So my company goes through audit. So one of the last thing they will do once all of their audit work is done and everything is tied in a bow, before they put the bow on, they will check for going concern. They will say, okay, does this company have enough cash? Do they have enough resources? Do they have enough things to continue their business given their commitments for the next 12-month period? If the answer is no, okay, if there is any inkling that the company might have challenges, in that case, the accounting principles requires us to move to liquidation accounting method. So this is where no matter what you have spent for your assets and all the stuff that you have on your balance sheet, all those numbers will be moved to liquidation accounting. Your auditors, sorry, my voice is starting to get tired. So your auditors will report the going concern on your auditor's report, and everything will change to for liquidation value. So this one is number 7, going concern. Okay.
Hi, Guru.
Now, sorry, I'll come to you, Mac. I think that was you, but give me 1 second there. I'm going to give you an example. So I have seen going concern only once in my career, and I've had quite a fruitful long career. There was this one company, I'm not going to give you the name, there was this one small company that I worked with, and they were into baby foods. Okay, so one of the things that, and I was actually just starting into accounting at the time. I was nowhere close to the experience that I have today. So I was really fresh. So you know, everything looks good when you start a company, right? They give you a good package and everything is nice and it's the best day ever. But as an accountant, keep in mind, you got access to resources that other people don't. So what I did with that company is I just looked at their financial statements from the prior year just to get a sense, and because I was a fresh accounting student and I wanted to bring my knowledge to use, right? So I looked at their financial statements, and one of the first things that I noticed is on their auditor's report from the last year, they had a going concern listed. And the reason for going concern was not because the company did not have enough cash. The company had decent cash, no problems with their balance sheet. It was looking actually quite healthy. The problem was that this company's 90% of their sales were to Walmart and 10% to the other small customers. So that is where the going concern came into play, because if Walmart stops to shelf their product, they are done. There is no way this company can survive because they are so highly dependent on single customer. That was the reason for the going concern. Okay, so I figured, that was not a good place to be. I found new, more challenging opportunities. That's how you package it and you move on in life. And yes, that's exactly what happened with that company. They had to restructure. Okay, sorry, coming back to you, Mac, go for it.
Hey, just a question. Can you elaborate the difference between what you've just explained as a going concern versus like a stress test that we often hear about for like banks and things like that? Is that kind of the same thing, just depends on who's doing it? Can you just touch on that briefly?
Well, stress test is basically done, you know, the term of stress test is actually coming into play with regards to the mortgages, right? So what they are trying to do is, okay, I like to teach with examples. So if you guys are not a big fan of that, then please feel free to give me sincere feedback and I will take that and make changes as I go. But this is how I do it, okay? So with us, so with my husband and I, we have a primary house and we have a couple of rental properties. Okay, so the whole idea of this stress test is the bank looks at our earnings, like the primary job for myself and my husband. They say, okay, this is how much income is coming in. Then they look at all the mortgage payments that we have to make. Let's say we have 3 properties that we have to make the mortgage payments on. They will take all of those as expenses. They will not account for the fact that, you know, 2 of those are rental properties and I would have rental income. So they don't do that. They want to know that tomorrow, if I'm not able to rent for whatever reason, the market is so bad that I can't rent them out, can I still pay the mortgage on those? That is stress test, which is entirely different than what liquidation is. Okay, so 2 different ways, 2 different people testing for just basically what they're doing is they're trying to ensure that their interest is protected. Does that make sense, Mac?
Yes, thank you.
No worries.
A question. I have a question, teacher.
Uh-huh.
How do you report if you have going concern about the business?
How do you report? Well, one of the things is your auditor's report will have going concern listed. Auditor's report is a 1-page letter kind of report that really outlines and says what your auditor thinks about you. Okay, or not about you. I mean, when I say about you, I mean the business, because that is the context we are playing in here. So that is the first thing. The other thing is, if the going concern is there, then there will be a second set of balance sheet that is prepared, which will list all of your assets based on the liquidation as of that day. So if I was to sell my asset today, how much am I going to get today? That is what your, let's say your asset based on your actual financial statement for the year end was 1 million. But under the liquidation value, your assets are only worth 300,000. Then your financial statement, your balance sheet will have your assets listed at 300,000. And you can't send that other balance sheet to the bank. Nobody will take it. They will take the one that is attached to the auditor's report.
Okay, one more question. So does liquidation value means the same as fair value?
No, fair value is different. Fair value is what is the market value of that today. Okay,
yes,
keep
yeah.
in mind, guys, there are, you know, and the reason that there are these different terminology is because they mean differently, right? Fair value means that, you know, my assets are worth, let's say I want to sell one of my rental properties. Okay, the market value of that is, let's say it's a condo for 200,000. Okay, the fair value of that condo is 200,000. I will wait to get a reasonable offer. I'm in no rush to sell this today because, you know, I don't have to, right?
Yeah.
So that's a fair value. But if I can't keep up with the mortgage payments and I'm in a really bad shape and I have to sell this today, then I will take whatever I can get for it today, because what's more important is to, you know, to get that liability off of my back. That is liquidation.
Yeah,
Does
got
that
it.
make sense?
Yeah, thank you. I appreciate
Yeah.
it.
Okay. No worries.
I have a question.
Mm-hmm.
So for this question sentence, it's kind of confused me. So the going concern is why plant assets are not reported at their liquidation value. Can you rephrase that, please?
Sorry, can you do that again? So if there is a going concern, all the balance sheet will move to liquidation accounting, which is discounted prices, basically throwaway prices, as we call them.
Right.
Is that good?
Then maybe
That's
the
why
question
it's
should have been, maybe that is why are reported. not are not, because if it's a going concern, we have to report that liquidation value.
Oh, okay. Because okay. So it's in the liquidation value. That's why it's not showing in the assets.
Mm-hmm.
Okay, I think I understand that the sentence. Thank you.
Yeah, and you know, the going concern is only listed if there is a concern. If there is no concern, then nothing is listed, right? That means everything is just hunky-dory and the business is going to be fine. All right. Moving on to E. Related to the economic entity principle defines the entity that should be consolidated in financial statements. This probably is one of the newer things that you probably wouldn't have seen up until now. What they're talking about is control. Okay. Now, control is an entirely different conversation. Frankly speaking, there is a whole course on control. Sorry, I've got throat issues, so just bear with me there. So control, the entire concept of a control, as I was saying, has a whole course around that, which is an advanced financial accounting course. Okay, so we will just leave it at control. It just means as who control whom. There is a parent subsidiary kind of a relationship, and that's what they're talking about here. So we'll just keep it at a very, very surface level because this is quite a complex place. Next one, I think we were at F, indicates that personal and business record keeping should be separately maintained. This is economic entity. The economic entity states that the business and the personal transactions should be kept separate because they are two different entities. We shouldn't be able... So, okay, sorry, I lost that again. Okay, so the business and the personal are two different entities, so we should be able to keep them separate. Okay. So G for, okay, so that was G. No, sorry, that was F. G is separates financial information into time periods for reporting purposes. This is the timeliness that we were talking, or the periodicity or timeliness is the same thing. This is what we were talking about earlier. So basically saying that the life of our business is broken down into smaller, more manageable chunks, which usually is a year. So the companies are expected to report on their financial statements every year. H, permits the use of market valuation in certain specific situations. This is your fair value. Okay, in certain instances, depending on what we are looking at, and they are very specific. Okay, there are certain types of investments that we can revalue at the market. So it really has to fit the criteria, and the accounting principles have to allow that. But what they are referring to in H is your fair value principle. Okay. Requires passing of risk and rewards, measurability and collectability before recording the transaction.
Just third, revenue recognition and realization.
This is revenue recognition, okay? So we are only able to recognize the revenue when the risk and rewards have transferred, when you can measure the revenue amount and you are certain that you would be able to collect. If any one of these items is missing or it's doubtable, then you cannot record that as revenue. Okay, and we would explain, or we would build on that concept more when we get to the revenue recognition principle, which actually is quite has a decent coverage in this course. And finally, this one assumes that the dollar is the measuring unit for reporting financial performance. This is monetary. Yes, this is monetary unit. So we are assuming that it is, you know, it's the dollar, and the dollar is stable between Canadian and US market. All right, lovely. So that is topic 1 for us. Do we want to take a quick 5 minutes breather here, just stretch out our legs and, you know, take it a little bit easy and then come back to topic 2 in just a few minutes?
Okay, good.
Yeah, please.
Yes, please. Okay, so this is 7:21. We are only going to take a 5 minutes break. Okay, so we should be back around 7:26-ish, and then we will get going. All right, you got 5 minutes? Go for it. All right, everyone, we are back into topic 2. So for those of you guys who did have the time to listen to those lecture slides, what do you think is covered there?
The accounting cycle.
The accounting cycle, perfect. Thank you, Debbie. Okay, so this basically is your appendix, okay? And that's why you're not able to see the chapter numbers. So the EC is your appendix. So basically this again is just a refresher. So we will try to get through whatever we can, and whatever is left at the end, you would have to do it on your own. Okay, so we will be talking about the journal entries, adjusting entries here, the closing entries. So basically the whole accounting process. So the accounting process is you start with journalizing your entries. Okay, then what do we do?
Move to general ledger.
Move to general ledger. Okay. What else? Then what do you do?
Balance.
Sorry?
Trial balance.
Trial balance. Okay.
Just trail burns.
Adjusted trial balance. Okay.
And then closing
Adjustments.
Adjustments.
Closing accounts.
Yeah.
Okay. Let me pull up the whole cycle. Where was that? I'm pretty sure I had at the beginning.
Yeah.
I'm pretty sure I had the cycle, but no.
Slide number 6.
Slide number 6. Thank you. You're a savior. There. I made the slides, by the way. Okay, so this is your accounting cycle. So we start with identification of an item. If it is economic, or it does have the economic bearing or the financial accounting in the financial information, then we do go ahead and journalize that. Once the process of journalization is completed, then we take that information. This is basically where on step 2 we do our debits and credits. Then we take those journal entries and post them to T accounts. That is the process of posting. Then comes your trial balance preparation, where the whole idea of a trial balance is to make sure that your total of debit equals total of credits. Then we do our adjusting entries. Okay, now for those of you guys who are not very comfortable with adjusting entries, do make sure to take the time on reviewing extra practice problems to refresh that concept, because that usually is the challenge area. In this Accounting 315 course, we are building on that understanding. So we are assuming that you guys are all good with the entire accounting cycle. Okay, so once the adjustments are done, there are 2 ways we can go about this. Once the adjusting entries are done, you can either post these adjusting entries to a worksheet, and I've shown you an example in the to the in-class problems there, and then prepare your financial statements. Alternatively, we can take these adjusting entries, post them to the T accounts here. Once those T accounts are updated with the fresh balances, then we will prepare the adjusted trial balance. From that adjusted trial balance, then we prepare our statements. Once the statements are ready to go, the last step there is the closing process. This is the last time we will do the adjusting entries in the, we will do the journal entries in this process. So closing entries is where we close the temporary accounts. So any account that are revenue, expense, or dividend accounts is what will get closed here. Once we close it, we prepare the post-closing trial balance one last time to make sure that all the temporary accounts are closed, and that our final check of total of debit equals total of credit. After that, these adjusting entries that you prepared in step 5, they would technically be reversed in the next period before you start the cycle again. Okay, so let's say if your year is January 1st to December 31st. So up until this step 9 is what will happen till December 31st. The reversing entries will not come until January 1st of 2020. Okay, so you guys are expected to know about reversing entries, and I think these were not probably discussed in the courses up until this point in time, but in the real world, this is how the information works. So the idea of revamping this course is also to align this with the actual practices that goes on in the business world. All right. So reversing entries, it's actually just the opposite of what you have done in number 5. Whatever account was debit would now be credited. Whatever was credited would now be debited. So you do exact flip. All right. So that is what we are looking at in topic 2. So we are
What
looking
is
at
the purpose of reversing?
well, if you don't reverse, then you will end up with duplication of charges. So let's say if you had accrued for utility expense, okay? If you don't reverse it, so let me come back here. Where did my PowerPoint go? Okay, there. So under step 5, let's say if I have adjusted or accrued for my utility expense. So there was a telephone bill that came in for that I knew came in later on. Okay, but as of the year end, the service was used up. So I debited my utility expense and credited accounts payable or accrued expense, accrued liability. Okay, that's my adjusting entry. Now, if I don't reverse that journal entry, then when that account or when that invoice is actually entered in the system, let's say in January, then you will have 2 expenses, one in January of 2020, the other expense in December of 2020. So you're doubling your expenses. So reversing entry will make sure that there is one transaction, hence just the one expense. It is 1-to-1. Does that work?
Okay, thank you.
No problem. And that actually is, you know, it's a very conceptual thing. I know the courses did not talk about that up until this point in time. And in the industry, we always felt that lag. Okay, so when the industry, when the accounting students are hired, or the, you know, even the CPAs are hired, they are expected to know all this. But unfortunately, the courses never talked about it, so they didn't know. So that's why these courses are being revamped to bridge that gap. And I'm trying to find where those questions are that we will be looking at. Let's see. So our first one was EC-3. Found it there. Okay, so we are going to zip through this really, really quickly, guys. This is a review for your journal entries. You guys got to be a pro on your journal entries and adjusting entries, closing entries by now. This is just a refresher, and that's how we are going to treat this. So EC-3. So LD Driving Range Inc. was opened on March the 1st by Phil Woods. The following selected events and transactions occurred during March. So on March the 1st, and we are doing the journal entries in the first step, and then in the second step, we will identify if there is any adjusting entry that should be recorded before preparing financial statements for the month of March. So on March the 1st, invested $80,000 cash in the business in exchange for common shares. Now, all the journal entries are from the perspective of the business. So cash is coming in,
And common shares.
and common shares are being credited. Just going to close out these files, then we don't have to worry about them. There. So debit cash, credit common shares. Easy peasy, lemon squeezy. March the 3rd, we purchased Mickey whatever golf land for $70,500 of cash. The price consists of $2,500 for March rent that was already paid on the storage warehouse, land that is worth $20,000, building that's worth $32,000, and equipment that's worth $16,000. So you are getting, so the actual outflow of cash, so credit to cash account is $70,500, but that cash is paid for various assets. So your capital asset is an equipment for $16,000, is building for $32,000, land for $20,000, and the other $2,500 is your rent that is already paid in advance. So that is your prepaid rent. So nothing fancy there. For March the 5th, to advertise the new driving range, LT sponsored and paid for an open house costing $6,800. This is advertising expense, debit to that account, and credit to cash. On March the 6th, paid $2,400 cash for 1-year insurance policy. This you got to tell me what the journal entry should be.
Prepaid debit expense, credit cash.
Perfect. Prepaid debit insurance or debit insurance expense, as long as, prepaid insurance or prepaid insurance expense is a debit. As long as you call it prepaid, it's good because then it will hit the asset on your balance sheet. If you call this just insurance expense, then we will have a problem because that insurance expense will hit income statement and cause issues.
Yeah, but we'll need to expense it the next month or for every month.
Yes, perfect. So eventually, yes. So every month, let's say if this is $2,400 policy for 12 months, then at the end of the month, we will go ahead and book debit to insurance expense and credit to prepaid insurance. At the end of every month, this adjusting entry will be booked. Okay. Likewise, if we look at this March the 3rd transaction, there should be an adjusting entry booked for that one as well to credit the prepaid rent and debit rent expense. On March the 6th, oh, sorry, we did that. On March the 10th, purchased golf equipment for $5,500 from Rory Limited, payable in 30 days. So this is the equipment, which is a capital asset. So we will debit our equipment account and credit accounts payable. On March the 18th, we earned fees of $3,700, which were billed on account. What's the journal entry here, guys?
Can you please show the question again?
Unearned revenue through earned revenue.
No, it's not on. It should be like service.
Service
Yeah,
revenue?
service.
So
revenue.
credit to service revenue for 37. Okay, I agree. What are you
Debit
debiting?
cash.
Accounts receivable.
Accounts receivable.
Yeah.
Okay, never try to memorize your journal entries because it really depends on what information is presented. If one of the variable changes, your journal entry will change. So what they're telling you here is we earned the fees of $3,700, which were billed on account. That means you already have accounts receivable sitting. So you are collecting against that accounts receivable. So we are going, we are going to debit our accounts receivable and credit service revenue. All right. So the accounts receivable was already sitting there. 25th, declared and paid $1,500 of cash dividend. This one is an easy peasy. Debit to dividend account, credit to cash. On the 28th, incurred and paid salaries and wages expenses of $1,900. If they're telling you that this is wages expense, then we will debit our wages expenses and we will credit our cash. On March the 30th, paid rent for the month of April in the amount of $2,500. We are in the month of March, and if we are paying the rent for April, then we will record this as a prepaid rent at the end of March when the payment is made. So debit to prepaid rent and credit to cash. In March, this will be adjusted.
In April, you mean?
Sorry?
You mean in April it will be adjusted?
Oh, sorry, what did I say? Did I say?
March.
Oh, I'm sorry,
Yeah,
my bad.
that's
Yes, you're right. It will be adjusted in April, so we will take it to rent expense and
that's prepaid.
prepaid rent will be credited for 25 in April, not March, sorry. Then for the 31st, we received fee of $750 related to golf tournaments that will take place in April. This, my friends, is your
Unearned revenue.
Revenue, cash to earn.
awesome. So debit, cash, and credit unearned revenue because this is a liability. As in when we earn this revenue, at that point in time, we will debit unearned revenue and credit the revenue account. But just to give you an example, so here, the other type of adjusting entries that you could end up seeing at the, during the year, at the end of the year, would be depreciation expenses, bad debt, and any accrual for salaries and wages. Any questions so far?
Please, can you repeat the reverse entry, please? The purpose and how?
The reversing entry, so if you have booked this, let's say, where is, we are getting into the adjusting entry, so we'll talk about it there. So let's look at EC.7. Okay, so adjusting entry. So the trial balance for Hannah Resort Limited on August 31st is as of below. So they have given us the trial balance with all of the account and the balance in those accounts. If you see the total of debit equals total of credit. Okay, so the total of debit equals your total of credit. Now they have given us 7 additional information transactions, and this is what we are going to do our adjusting entries for. Then they're also asking us to prepare an adjusted trial balance at August 31st. So the first one, the balance in prepaid insurance includes the cost of 4 months premium for insurance policy that will expire on September the 30th, 2020. So we are looking at prepaid insurance account. So prepaid insurance account is worth $3,500. That was the balance on August the 31st, 2020. So the balance in the prepaid insurance account was for 4 months of premium. And that total balance expires on September the 30th. Okay, so a portion of that insurance has been used up. So we got to credit this prepaid insurance account and debit the insurance expense. So $3,500 divided by 4 times 3 months.
You divide it by 3 because this is the remaining 3 months, the remaining of the 4.
The 3 months have gone by, but the total were 4 months. So I divide that by 4 to get my monthly, and then I multiply that monthly with the 3 months that I need to account for. You can do it in so many different ways. It's just math. Okay. Number 2, inventory count on August 31st shows $650 of supplies on hand. So what they are referring to is the supplies account. So supplies here is worth $1,800. They are saying that whenever this got recorded, $1,800 was fine, but at the end of the year, the supplies on hand is only $650, which means the difference in those two numbers is now used up. So we will credit the supplies account to bring the asset down, and we would put it to supplies expense account because it is now used up. You are only left with $650 of supplies, and that is what will show up on your trial balance once we get to that. Building and equipment are depreciated straight line. From the date of purchase, the building has an estimated useful life of 25 years, and the equipment has an estimated useful life of 10 years. Both asset categories, residual value is estimated to be 10% of cost. Okay, so what we are doing here is they are not telling you to do anything, but the silent requirement is for us to book the depreciation expense. So we debit the depreciation expense and we credit accumulated depreciation. The question then is for what amount? So there are two assets involved here. There is a building and equipment. Okay, so if we look at the building, so the building was purchased, this is historical cost, guys. So the building was purchased for $142,000. Out of that, 10% is the estimated residual value, and this building is going to last 25 years. So all I have done here is taken the $142,000. Out of that, I deducted 10% residual. Divide that by 25 years to get my per annum or per year depreciation. In this case, our adjustment is only for 3 months out of 12, so I have just done it for 3 months or 1 quarter. The same idea is applied to your equipment. So the total equipment cost, and that 16,000 is coming from your information that was stated. So your equipment is worth $16,000 it cost. 10% of that comes out as the residual value. The life of that asset was 10 years, so I calculated the per year depreciation and adjusted that for 1 quarter. Then for number 4, rent revenue includes amount received for September rentals in the amount of $8,000. Number 2 of the unadjusted unrevenue rent of $4,600. Oh, there are 2 parts to that, sorry. Okay, so number 4 has part 1 and part 2. So part 1 is the rent revenue includes amount received for September rent in the amount of $8,000. So this rent revenue of $68,002 includes $8,000. Is there anything wrong with that?
We haven't earned it yet.
You haven't earned it yet. Perfect. That means you cannot call it your revenue. Okay, so that means your revenue is overstated, which is wrong. So we have to bring this guy down. So we are going to debit the rent revenue and credit unearned revenue liability because it's a liability. Someone paid us in advance and we owe them a product or a service. Okay, part 2 of that conversation. Of the unadjusted rent revenue of $4,600, 1/2 was earned prior to August 31st. So if we look at the unearned rent revenue, which is here, $4,600, they told us the total there. 1/2 of that is now earned, which means the liability that was stated onto our trial balance is really not fully correct. Some of that is now earned. So you got to reduce your liability. So we will debit this unearned rent revenue account and credit our revenue because now we have earned it.
We're recognizing the revenue now, right?
That's right. Then for number 5, salaries of $375 were unpaid at August 31st. So if they were not paid, we still got to record them. So debit to salaries expense and credit to salaries or wages payable. Either of those accounts is fine, whether you call it salaries or wages, it's all good. And lastly, oh, maybe not last, the rental fees of $800 were due from the tenant at August 31st. Use accounts receivable. So in this case, we have earned the money, but it's just not received yet. Okay, because it is earned, it becomes credit to our revenue account and debit to accounts receivable.
Did
Okay.
not say that it's earned.
Sorry?
The question did not say that it was earned.
Well, the question is implying that it was earned. It doesn't have to tell you everything, right? It's telling you, but in an indirect way. So the rent fees of $800 were due from tenant at August 31st. So it is for the month of August that the fees was due. So you have already earned it. So they didn't tell you, but they implied it.
Oh, okay. Yes, thank
Yeah,
you.
tricky, right? Okay, so the last one then is the notes payable interest rate is 8% per year. And the note has been outstanding since December the 1st, 2019. No principal repayment are due. Interest is paid twice per year on June the 1st and December the 1st. So if we look at our notes payable here, so your notes payable liability is $77,000. There is no principal repayment that has happened and our interest rate is 8%. So what they are basically, indirectly, they are telling you to calculate and book your interest expense. So debit to your interest expense and credit to your interest payable. At the end of the period, if there is anything related to interest, you have to book it. So the principal of 77,000 times the 8% times 3 over 12-month or adjusting period.
Why is it 3 months?
Why is it 3 months? Does anyone want to take a stab at that? On what date are you doing your adjusting entries? On August 31st? Last rent was paid on June the 1st.
3 months, yeah.
So June, July, August? That's what your 3 months are.
Okay,
Does that
I
work?
see. Yep, thank you.
No worries. Okay, so that is your adjusting entries, guys. Okay. So here I have shown you the trial balance. All right. Now I haven't done anything fancy here. This part of your trial balance, if you look at the total is $264,850, which is what was provided to you. $264,850. So I just typed out all of that information. I didn't do anything. I haven't created anything. I haven't adjusted anything. It's just a bring over, a starting point. Okay. So this was your unadjusted trial balance. Then we were smart enough to do all of those adjusting entries, right? So this is the workbook approach that I was showing you on the accounting information. On that step 5, there were 2 approaches to do this. This is one of them, which is the workbook approach. Okay, so all I have done here is I have updated the balances in the adjustment column for debits and credit. So what I did technically was my first journal entry is insurance expense for $2,625. I'll show you first couple. So find our insurance expense account, insurance expense here. And on the journal entry, it was a debit. So I brought that number into debt. So, oh, you know what? Am I in the wrong? Of course I am. There. Okay, so I've just linked that information, and that way you will know how the information is flowing. Then I came to the prepaid insurance account and credited that as per your journal entry for 2,625. So prepaid insurance guy is right here. And in the adjustment column, I'll go to the credit side and plot that number here. So I have followed that same process for each one of these journal entries that we did here. So from journal entry 1 to journal entry 7, all I did was bring that information to these two columns. I haven't changed anything. Once I have all the information, I've quickly thrown the totals for the debits and the credits to make sure that there are no posting errors or journal entry errors. If there are any visible journal entry errors, this is where you should see it. So our total of debit equals our total of credit for 18,428. Once that is done, then we need our adjusted trial balance. So with the adjusted trial balance, now this was my unadjusted trial balance that we started with. Then we had the adjustment. So now I just need the adjusted numbers. So for cash account, cash is cash. There was no adjustment done. So I have an ending balance of debit for cash. For accounts receivable, same thing. There was no beginning balance, but there was a debit of $800 coming through adjustment. So that means my accounts receivable is now $800. Now for the prepaid insurance, we started with a debit of $3,500. During the adjustment process, we credited $2,625. That means my debit side is still heavier, so I will take the difference on my debit side. So I just did the debit minus the credit. Does this make sense? Same thing with supplies. It's opposite balance. We started with a debit, then we credited something. So our difference, because it's an asset account, the normal balance is a debit, $650. So that's how I completed the adjusted trial balance piece here. Any questions up until now?
No.
Does this ring a bell? You guys have done this in the past, right?
Yes.
Yes.
A distance bell, even a distant bell is good. Okay, that's good. Okay, now coming back to the question that somebody posed with regards to the reversing entries. So let's say, oh no, not this one. Which is what would be a good example? Okay, let's take this guy. Anytime you are booking the adjusting entries, you have to go ahead and reverse at the beginning of the following period. Okay, nobody talks about that. I'm not sure why they don't talk about it. The textbook don't say anything or clearly indicate that, but that's the whole point. Okay, when you're booking the adjusting entries, okay, just taking a step back here, guys, the whole idea of adjusting entries is to make sure that our revenues, expenses, assets, liabilities, and equity accounts, they are truly representing the values that should be in those accounts. Okay, so it's an internal process where we are throwing the entries to correctly reflect the balance in those accounts. All right, now these are, at some point in time, these entries will come to fruition. All right, but that does not mean you go ahead and reverse everything that was booked through adjusting entries. There are some entries which will need the reversal. There are some entries which will not need a reversal, and that is where you got to be able to distinguish. Okay, for example, if you look at this entry number 2, where we reduced our supplies account and put that to supplies expense account, this guy is not going to need reversal because once we book this, the balance at the end of the year was correct and there is nothing else that needs to happen in the following period. Okay. However, if you look at this accounts receivable and rent revenue, let's see what that transaction was. Does this even need reversal? Rent fees of $800 were due from the tenant. Okay, yes. Okay, so that's a good example. This will need the reversal. So this is what you did at the end of August. Let's say now you're on September. Okay, September 5th, they send you a check. Money comes in. You say cash is debited for $800, and you said, well, I earned it, so I'm going to take this as revenue. So far with me?
Yeah.
Right?
Yes, yes,
Makes
yes.
sense, right? Okay, perfect. Okay, so this is what you're going to do on September 5th. Now, the problem with this is, how many times did you get the money? Just once,
Yeah.
right? You earned it only once. But here, if I don't do the reversing entry, then you are technically telling me that you have earned this money twice, which is a problem.
Yeah.
So reversing entry will take care of that problem.
But
Does that answer?
can we just credit the account receivable and then debit cash?
Yes, you can. You can, but then that becomes an adjusting entry, but then that's not a reversal. Okay, a reversal is where you take this guy. So before I record the cash, so this is how it's going to work out on September the 1st, or I could do this on September the 5th. It doesn't really matter. I would debit rent revenue and I will credit AR. It has to be an exact opposite. This is reversal. What you are saying, that will give you the same effect and you can do it. Nothing wrong with that. Some people take that approach. So when it comes to reversing entries, if you recall in that, it said it was optional. That's the reason, because some people like to reverse it. I will reverse this thing because that ways it gives me a very clear auditing trail. I can look at that entry and say, okay, I booked it on number 6, then on September the 1st. So I booked it in August, then I reversed on September 1st, and then September 5th, the fresh entry came. So I like to use reversals. I'm a very big fan of that, but not everybody does. Okay, some people say they will just go ahead and adjust this guy to debit cash and credit accounts receivable, and they will be done. They would not touch the rent revenue, and there's nothing wrong with it. That also works. So whatever your preference is. Well, Kevin, it might seem like that, but this is what's required in order for you to make sure that you're not double counting your transaction. So work or no work, we have to make sure that we truly reflect on the actual economic transactions.
But let's see, let's say in company, let's say in your company, is it required to do reversal?
No, it's never a requirement. It really depends on the accountant as to what they prefer and how they want to deal with it. At the end of the day, all I want to do is when I'm looking at this transaction, the correct way to deal with this is just make sure that your rent revenue is recorded once. That is the goal. Whether I achieve that goal either through the process of reversal, which is booking the first journal entry and the second journal entry, or alternatively, as you guys are saying, hey, that's too much work, I don't like it, I'm going to do this. I am going to debit cash and credit accounts receivable. I'm fine with that. It will give you the same result. So that's, that is up to you. Whichever.
Aren't you supposed, are you not supposed to, you got your rent revenue in August, aren't you supposed to claim it in the month it was received? Like, isn't that part of the process?
No. And that's where it is wrong, because, it's our process is tied to when we earn, not when we get the cash, because cash can happen anytime. It might happen in advance or.
We earn the revenue in August. The way you're doing it, because you're taking it out, you're saying you earned the rent in September, but you actually earned it in August, right? So.
And you are right. And that's exactly what I'm saying. But what you're missing here is, I'm saying, so this is my August. In August, I only had one rent. Agreed? Okay. Now this is my September. I'm not double counting. If you think of your T account, make a T account for rent revenue. I'm debiting 800 and I'm crediting 800. That means the T account for rent revenue is 0.
Yeah.
Right? So you and I are saying the same thing, but just interpreting that a little bit differently.
Okay. Because, yeah, I thought because you made the revenue in August, but on your T accounts, it'll show that you actually made the revenue in September.
No.
Yeah, it has
the revenue. Hold on 1 second.
The
so the rent revenue was earned in August. So if I make 2 T accounts, one in August and one in September, Okay.
Mhm.
The net, so in August, my rent revenue will have $800. That's exactly when I earned it, and that's when I'm saying I earned it. Okay.
Okay. Okay.
When I
see.
come
I
to,
understand. Yeah.
make sense?
Yes.
Okay.
Yeah. No, I
Okay.
get it now. Yeah. Yeah.
Okay, no worries.
I think the point is that we haven't received cash in August, so that's why we put an accounts receivable. Then we get the cash, so we have to get rid of the accounts receivable and put it on a cash account, right?
That's right.
Yeah, so okay.
And you know, there are, as we said, it's just a matter of preference whether you use the reversing entries or you go ahead and adjust that. I know some people, they don't like reversing entries and they go ahead and use an adjusting entry. So this is this or this, guys. Okay, so this is an adjustment. So they can go ahead and start adjusting that. The only problem and it's my personal opinion, the only issue I find with that is in the real business world, it becomes rather hard to track a transaction, because keep in mind, with the volume that my business goes through, it's immense volume of transactions. Guys, if you're not talking, please mute yourself, just for as a courtesy to everyone else. Yeah, so it you know, the audit trail is not very clear. So if somebody was to come and try to make sense of your information, it becomes rather hard. So I'm a big fan of reversing entries, but not to say that that's the only way to do it. All right.
Question. On this question, September 5, when you make the entry cash to rent revenue, we are recognizing the revenue twice. So
no, we're not, and that's what we were talking about. Make a T account for August. There is only once, and then make a T account for September. So when you make the T account for September, there will be a debit and there will be a credit. So your net effect will be 0.
yeah, net effect will be 0. But when you make the entry, we are recognizing revenue. That's what it implies, I think, when you make an entry.
So
but you're making 2 entries, right? It's an in and out. The net entries will net out to 0.
I know that, yeah. But the first is reversing, it's okay. But how can reason out this cash to debit cash and credit rent revenue? So
okay, I'm sorry, I'm a little stuck here. So, so if you make the T account for August, your rent revenue is recognized here. Make your T account, okay? Sometimes it helps to just make it. So just make your T account for September. So yes, I see your point that you're telling me that I recorded the revenue here. Yes, I did, but I also reversed a revenue here. So we can't ignore that fact. They're not 2 different conversations. It's part of the same conversation. So it's in and out. So if I look at my income statement, my revenue account for this particular transaction, let's say there was nothing else in September. This was the only revenue they had. Then the revenue will be 0 because it was already recorded in August.
It could be either interpreted in the way that, you know, account receivable is just it's like the money which we will receive but it's not received yet. So if we are doing an adjustment entry before in August 31st, because we have to use the matching principle, so which means that we have to record it. So once we receive the money, we have to pass the entry. So cash to rent revenue or cash to account receivable is just receiving the money.
That's right.
Yeah. So it's
That's
just
right.
so we need to
Mhm.
because we have ended because August 31st we have ended that, but we still know we still know that the money account receivable we need to reverse the entry while we are starting the new, like you know, after the period we have to at the beginning of a new period we know that those money is pending. We have to reverse it.
Exactly. Yeah. Yeah. And it really, you know, as we said, it's just a matter of preference. Just pick one or the other method. But if the question is asking you for a reversal entry, then you have to. Then, you know, at that point in time, you really don't have a choice. So when you have a choice, you can go ahead and use it in the business world. But if you don't, then I guess we don't. All right. We are going to move to C-11 there. So C-11, we are actually running a little bit behind. So we'll just do this, and what is the last one on? Let's see. So this we will leave for homework for you guys to do on your own. This is more adjusting entries. Okay, C-11. Okay, so this is the closing entries, and this practically is the last set of journal entries that we do in the accounting process before the books are closed for the year. Okay, so when the companies, remember the timeliness or the periodicity principle that we were talking about, so we said the business has to prepare their financial statements once every year. Okay, so when they're preparing their financial statements, let's say from January to December 31st, the January 1st of 2020 becomes a new year. So you're going to start afresh. Okay, so all of those temporary accounts, which are your red accounts. Okay, when I teach the prerequisite courses, these 250 and 210, I always tell them to think of red color. Okay, so the closing entries are for red color, which is R is your revenues, E is your expenses, D is your dividends. So red account or the red color are your temporary accounts. So anything that's temporary has to be closed, meaning we need to bring that account to a zero balance. Once we move those accounts to a zero balance, then we do have the ability to reuse those accounts, because from the company's perspective, when they're looking at their income statement to say how much was the revenue in 2020, that purely is 2020 revenue and 2020 expenses. Okay, because you started those accounts fresh. You don't want to see cumulative revenues and cumulative expenses, because that way you can't decide anything at all. You have no idea what's going on with the business because it's all cluttered. Okay, so with the temporary accounts, we keep them for a specific period. So if you are looking at these accounts, we are quickly going to go through the accounts, and what you are going to help me with is let me know whether this is a temporary account or not. So inventory account. The D in red is dividend.
Yeah.
So revenue, expenses, and dividends.
No.
So inventory account.
It's asset. It's not a temporary account.
No.
It's a balance sheet account. Any account that goes onto your balance sheet, guys, is a permanent account. You are not supposed to bring those to a zero balance. It's criminal. Okay, like somebody is going to be mighty upset if you were to mess up with those balance sheet accounts. They are permanent. What about the FV through net income investment? So this is FV is the fair value, NI is net income. Okay, so this is probably a new item, so I'll walk you through that. So fair value through net income is an asset account. So this will be listed on your on your balance sheet as a current asset. Okay, so that's a permanent account as well. So we are not going to touch that, just leave it be. Retained earnings. Retained earnings is a special account. Guys, please mute yourself when you're not talking. Thank you. So your retained earnings account is a special account. Okay, now when we prepare our financial statements, remember right when we started the class, we said there were 4 financial statements, and we said the information from one flows to the other, right? We remember that conversation. Now, how does the information flows? Is through this closing process. All right, so there we just conceptually say the information flows, but it just can't fly by itself, right? We have to do something in order for it to move from one statement to the other. So that something is your process of closing. Okay, so when we are taking our revenues, expenses, and dividends, they will eventually all come to this retained earnings account. So this account is really special. So you always throw a star besides that one, because we will use that and update the balance, but we are not going to close it. So there is a difference. Okay, so we will use the account, but not close it. Dividend account is part of your red color. So yes, that's a temporary account and we are going to close it. So the normal balance for the dividend account is what?
Debit.
Debit. Perfect. So the normal balance is debit. So if I want to bring this account to a zero balance, then I should credit. Agreed?
Yeah.
Perfect. So that is what we will do. And in a bit, we'll see what's the other half. Sales revenue is the revenue account, which is a temporary account. So yes, we will close that. Sales discount.
Temporary.
Temporary. And sales returns and allowances, that's a temporary one too?
Yeah.
Why is that temporary?
Because they all goes to the income statement and everything on the income statement is temporary.
Okay. Have you guys heard the term contra account?
Yes.
What does it mean?
It has two existing entries.
The
It has
opposite.
to double effect on the accounts.
Okay, let's see what the others have to say. Go ahead, guys. Somebody that I haven't heard today. What are contra accounts?
Contra account is an account which deducts the main account, like fixed assets. They don't have accumulated depreciations like a contra account.
Okay.
Like an
Anyone
opposite,
else?
like an opposite account.
Contra accounts. Hello.
Sorry. Yes. Sorry, Ariana. What was that?
It's like an opposite account to a main account.
Okay, fair.
Yeah, hello.
Yes, Rosalind.
Yeah, so I think that the contra account is the opposite account to the main account that is used to balance it out to zero.
Okay, so then what you guys are telling me is that contra account is something that always is attached to a main account. Fair, right? Okay, think of contra accounts, okay, and I always like to use analogy, as I said, you know, when I'm thinking or trying to memorize something so that it's easier to remember. So I always think of contra accounts as my kids. So I'm a parent and I have contra accounts attached to me. Contra accounts are always attached to a parent. There has to be a parent account. They cannot exist without a parent. Okay, that's first and foremost. The second and most important rule of a contra account is to deplete the parent account. Now think of my kids. Their sole purpose in life is to deplete my earnings. Okay, that's the main purpose of their existence. That is what a contra account is. You're welcome. I know. Okay, if there are any parents here, I'm sure you would agree to that, right? Okay, yes, okay. So that's what a contra account is. No matter what context you look at when we are talking about a contra account, and try to come up with your own analogies of remembering things if you're going to have any sort of accounting career. Okay, it's just my way of thinking, but there are so many different ways you can analyze the information. So no matter what context you look at the contra account, because this is a contra account to income statement, but there are other contra accounts on balance sheets and stuff, but their whole function or the purpose in life, it's still the same. Okay, so that's what that is. So coming back to our contra account, so if sales revenue is our parent account, then the babies are going to go with that, which is your sales account and your sales, the sales discount and sales return and allowances. The only problem is the normal balance for the sales revenue account is a credit. The contra accounts will have a normal balance that's exact opposite to the parent. Okay, so you will have to do opposite of opposite to go ahead and bring them to a zero balance. Then comes our cost of goods sold. So your cost of goods sold is also a temporary account. So cost of goods sold is like an expense. Sorry. So cost of goods sold is a temporary account. It's like an expense. So expense accounts have to be closed. Administrative expense, that is a temporary expense or the temporary account. Income tax expense is also temporary. The investment account goes onto your balance sheet, so it's not temporary. So once you have determined what accounts to close, then you always follow the process of closing in the same order of your color. So your revenue accounts first, expense accounts after, and lastly, your dividend accounts. So the normal balance for your revenue accounts, oh, sorry. Okay, sorry. The investment income is an income account. I think I accidentally said it was a balance sheet account there. Sorry, my apologies. I take that back. So investment income is an income statement account, a revenue account. So the normal balance for the revenue account is credit. In order for you to close it, you would debit them. And we are crediting the income summary account. Okay, now income summary is another temporary account that comes into existence just for the process of closing. You will never see this guy anywhere else. It only comes to life for this 4-step process and then it dies down again. Okay. Same thing with the expenses. All of your expenses have a normal balance of debit. In order to bring it to a zero balance, we are going to credit this and debit against the income summary account. So once you have done this, now your income summary was a new temporary account that came into play. But because we said this guy doesn't have any existence, we have to now bring this account to a zero balance. Okay, so we look at the credit in that account was 393,000, but the debit is 297,000, which means there was credit left in that T account. So in order to bring it to a zero balance, we are debiting to bring it zero. Now the credit is 393,300, and after the third journal entry, your debit is also 393,000. That debit is washed against the retained earnings. So the normal balance for retained earnings account is a credit. So if you're crediting that account, then the balance is going up. Okay, so in this case, that means the company had revenue. If this journal entry was flipped, it could very well be flipped. The income summary doesn't have any normal balance. So if this journal entry is flipped, that means the company had a loss. And there is nothing wrong with that journal entry. All right, so if your expenses were more than your revenues, then you would just flip this journal entry. And finally, we close our dividend against the retained earnings, so debit to retained earnings and credit to dividend accounts. That, my friends, is topic 1 and topic 2, which is purely a review of your prerequisites. And this is pretty much all just revising and getting our feet wet and getting comfortable with what's coming next. But anything that we are going to see from now onwards is going to be new material. Any questions?
Okay, I don't have questions, teacher. What kind of income we can categorize them as investment income?
That is an investment chapter. That is chapter number 9 we will look at, or the last chapter in this class that we will look at is your investment. So we will discuss those there. And there is a whole lot that goes into the investments. Yeah, so it's not an easy answer. It really depends on the type of investment and how the business is classified, so on and so forth. So it's an entirely different ballgame. We'll learn about it there.
Okay, thank you.
Yeah. What else? All right, in the meantime, if you guys are thinking of your questions to form or address or whatever, so today's class, guys, and I don't want to scare you, today's class, it has gone a little bit much longer, frankly speaking. The class shouldn't have to go anywhere more than an hour and a half, frankly speaking, given that the lesson notes that are posted are about an hour or so or more. Okay, so technically speaking, what we have covered today between the video lectures that were posted and today's class is about 4 hours of material. Okay, so yeah, so going forward then, do make sure to review your videos. And you guys have done amazing. I'm not saying that you haven't. You guys have done amazing. The participation has been great. And I appreciate all of you guys sticking up until the end. And, all of that feedback, it's amazing. So keep it up, and we will be meeting next week. So I will post your information or the lesson notes for the following chapters as soon as I can. I'm working on that. So do review those before your class. We will not be talking about that. We will do the same approach where we actually jump into your practice problems. So next class, we are looking at, where is my schedule here? So next week, we are looking at topic 3 as well as topic 4, which is about statement of comprehensive income and statement of changes in equity. Okay, so we will be going through a bunch of examples. If you do get some time, I would highly recommend that you look at the practice problems that are already posted on D2L and take a stab at that. Okay, so under the IC, the in-class problems, the chapter or the topic 3 and 4, there is one Excel sheet posted. So take a stab at that. So that is what we will focus on next week.
Guru, may I have a question? If you would like to practice more, in the Willy, there is a questions and there are also answers, right?
Absolutely. So for, where is it?
Or
Okay.
do you have the answers somewhere in a D2L?
Yep, it's right here. So you guys are
Okay.
seeing my D2L screen, my cursor hovering, right? Okay.
Mm-hmm.
So you know what, and I'm not saying that Guru's Corner is the only place that you guys have to refer to, but this is where I post my material and that's how I would communicate to you. But there is a bunch of other information on D2L that you should absolutely have a look at. So one of the things is the solution set. For every topic, there is detailed solution set that is already posted. So please make sure to go ahead and take a look at that.
That's
And if you
perfect.
run
Thank
into
you.
any problems and you don't see the complete 12th edition solution sets and stuff, then feel free to shoot me a quick email.
Sounds good. Thank you.
Yeah, no worries. And you know, at the end of the day, it's, you know, practice, and more practice is only the thing that will get you through the course. This is not a spectator sport just by watching me do it, or, you know, even if you are there for the live session and you haven't practiced the examples, you just can't. Okay, and you don't want to take the chance on the exam, then it'll be too late.
So practice problems are where again?
In your textbook?
Oh, so basically just do whatever practice problems are in the textbook for the topic 1 and 2, and then...
Yeah.
Okay. All right. Thank you.
And if you think that there is something you're coming across, and there are a bunch of different concepts that are covered in the textbook as well, sometimes we don't cover everything, and that's why the topics are a little bit scattered. They don't follow completely the chapter layout. So in that case, if we haven't talked about something, then I'm not, yeah, I'm a very fair game. If I haven't talked about something, I'm not going to examine on that. Okay. But if I have talked about it, then the expectation is that you would know. So that's where that is. So if you come across something and we haven't discussed that in class, then yeah, just, yeah, find another example to do. Anything else, lovelies?
No, thank you.
No problem. It's getting late, and I sincerely do appreciate all of you guys logging in and practically getting through the whole class when we said it wouldn't be. So I know. Usually that happens for the first class just so that we can get lay of the land. But thank you so much. Do make sure to log in next week, same time, and then we'll talk more. Bring your questions, concerns, problems, and we'll talk it.
So we can use the same link every time to log in, right?
Yes. So the link that is posted here under Guru's Corner, under, where is that? Guru's Corner, under the Zoom class link, that class will work every single time.
Okay, sounds good.
Okay, maybe my session has timed out. That's why it's not letting me, but yes, it would.
We'll take the link.
Great, thank you. Have a good night, everyone.
Yeah, have a
Good
good night,
night,
guys.
people.
Okay,
Good
thank
night.
you.
Good night.
Study hard, and I'll talk to you guys next week.
Bye, everyone.
Bye.
Thank you. Bye.
Bye, everyone.
Bye.
Can you tell me the link for the code for buying the code, please? I forgot it.
I'm sorry, what's that?
The link to get the course code.
It's all there. So you will have to log into your D2L and go to Guru's Corner under General. So you would be able to download it from there.
Under General, okay.
Yes, yeah.
Okay.
There is a flyer that's posted for Wiley Plus.
Okay, thank you. Appreciate it.
No problem. Okay.
Okay, see you. See you next
Okay, talk to you next week. Good night.
Okay, good night.